Thank you for joining us for today's HVS Live Insider Briefing. We are here to give you our mid-year update on how we see the world of the U.S. hotel industry. And thank you very much for joining. We have a data-packed, insight-packed 45 minutes here for you. You're sure to learn a lot, and thanks for being here. We wanted to start with just looking at our pre-webinar poll that many of you participated in, just to get a pulse of where we're at right now in the industry, what we're thinking. Are things good? Are things troubling? Are things so-so? You can see that about 60% of you think that things are on the uptick. Things are in a growth mode, which always feels good, doesn't it? 26% in the stability range, and 15% feeling a little bit more hesitant, feeling like things aren't quite so rosy in the decline mode. I thought that maybe it would have been more than 60%, but I'm certainly okay with how this turns out. Interested to get your thoughts on where you think things should be at. We're going to do a little poll later on today, so you'll be able to chime in. Want to get right to some national performance trends so you can see where we think things are going to be headed this year. After an occupancy decline, we see a rebound happening right now. Right now, we are at 63% for the year. We are monitoring this closely. Things are definitely on the uptick this year. We might be revising that upward depending on how the summer shakes out. If the summer travel season ends up being super positive, we'll certainly take another look. We were already pretty optimistic for this year. We were in the high 62s, but now we up that to 63 based on what's happened so far this year. And we're going to do a little deeper dive here in a second about what is happening this year and why are these occupancy levels going up like this. And beyond into 2027 and 2028, we're looking at headed back towards that 64% mark. Maybe sooner rather than later. We'll see how things go. 26%, 2026 occupancy is improving. Despite some of the headlines we see out there and the news, people are traveling and people are traveling at greater levels than they were last year and paying some pretty strong room rates. Why is this happening? We want to kind of get underneath that. Many of these things we did, like I said, we did see at the beginning of this year. So the fact that occupancy is on the rise isn't too much of a surprise to us, although the level of RevPAR growth that we're seeing is a bit stronger than we thought it would be. So why is this happening? We had a very strong spring break season. We had more folks that were opting for stateside destinations this year, perhaps versus going over either overseas or to Latin America. Those markets still saw some pretty strong results. I did just pull some stats on some of those international markets so you can get a sense of what we're looking at. Cancun is for the last 12 months is down a point of occupancy. Puerto Vallarta is down 3 points. Tulum is down 7 points. Dubai is down 6 points of occupancy. Occupancies are still relatively good for these markets despite the decline. But some of that demand perhaps staying stateside versus going to some of these international destinations. ADR in most of these destinations remain on the rise to the tune of 4 to 5%. Tulum is down 3% in occupancy, or in ADR. So we are kind of experiencing that right now. International travel losses, we saw those occur in last year's market. We're not necessarily seeing a lot of that international travel return to prior levels this year, but we're not seeing the decline that we saw last year. So that's helping matters. And we've got a key market some key market comparisons happening this year that are better than what we saw last year. So we'll remember that last year we had LA fires that impacted the LA market and certain submarkets in particular in LA. Those certainly didn't recur this year. Houston had some pretty big weather impacts in 2024 that spiked demand in that year. And so the 2025 comparison wasn't great. And so now that we're in 2026, things are looking better. So by comparison, that market is up. Austin and Dallas saw convention center closures for their redos happening in those markets, and that really showed a negative comparison last year. This year, things are better, or things aren't not necessarily that much better, but things aren't showing the decline that they showed last year. We have better convention calendars in cities like Nashville, Las Vegas, and Denver. So that's prompting some better numbers this year. The Bay Area is certainly having a good year, not back to where we were back pre-pandemic for the Bay Area, but much better than last year, with a ramp up in demand from sources such as AI, research and development, and growth. And of course, we all saw it in the news with the Minneapolis area earlier this year with the ice surges that were happening up there, and ultimately a lot of travel related to that. So MSP saw a market saw a pretty big spike in early weeks of the year. That's been a contributing factor. Last year, it was a shock and awe, so to speak, of what was happening in the federal government with DOGE, with tariffs, with one thing after the other. And as time moved on, that kind of shock tends to fade, and we start getting used to perhaps a new normal. That happened in the first half of the year in particular. And so now we're seeing in this first half of the year some pretty positive comparisons as those types of shocks end up fading. Also, in the second half of the year, we saw some interest rate relief and the stock market recovery after the big stock market decline in the first part of the year. That came back very strong. And so our stock market this year, and at this point in time, is looking very good. When you have that occur, folks are confident. They see their savings accounts, they see their stock accounts back up to levels that they are comfortable with, they're happy with. They see interest rate with an interest rate decline. They maybe see their interest rate costs declining or certainly not getting any worse. And that this type of a feeling leads to folks being more confident to book those book those vacations, book those trips. And they may have booked them last year, but maybe they weren't quite as long. Maybe they didn't book hotels that were at the level of hotels that they really wanted to stay at. And so with increased confidence, we're seeing that kind of return to return to travel. If some of that travel was delayed altogether last year, then this year, with those trips being scheduled because they didn't necessarily do a trip last year, we call that revenge travel. So they want to get back to it. They want to book that trip that they didn't get to book last year. Things are looking better. And so that's contributing to it as well. So lots of good things happening. It's not just one item. As you can see, there are many, many different factors coming together to kind of produce this better performance trajectory that we're on right now in the U.S. So despite those headlines, these things are really helping our industry. There are even more things that we're hoping for on the other side of the slide that you can see that can then take our RevPAR even higher, get that occupancy back up to the 64, 65% where we like to see it, and get that ADR growth back up to where we need it to be to cover our increases in expenses. Certainly a sustaining U.S. Iran ceasefire. We'd all like to see that. That's certainly something in our future we can all hope for. Easing inflation. We're already starting to see some of those oil prices decline. We certainly want to see that sustained and see that keep moving in the right direction. Will we get a couple more interest rate ticks down from the Fed? We can all hope for that. Certainly remains to be seen whether or not that will happen, but some changes happening with the Fed board might move us in that direction. We'll see. We want to see our Canadian friends and Asian travelers that haven't been coming to the US come back. We lost a good 30% chunk from Canada, and that chunk isn't coming back yet. We were certainly hopeful that maybe that that would start to come back this year, but we're not seeing a big movement on that yet. And certainly someday, hopefully, knock on wood, everybody will get back to normal on the international travel scene, and that will really boost these markets where they need to be. We need to have continued steady employment and a strong stock market that always plays into boosted confidence and right levels for to support travel and GDP growth and ADR growth. All things that we are looking forward to in the coming months and things to be kind of tracking and seeing how we're doing. ADR growth, we're at roughly 2.5% this year, moving up $3 in 2026 before we get to a more robust $5 increase next year and another $5 in 2028. We are watching this as well. This might move up a little bit depending on how summer goes, but right now we're at about a $3 increase, really being fueled right now by big increases in the luxury and upper upscale segments in particular. Our supply growth remains on the low side, not surprisingly. Still very expensive to build, takes a while to build. Just the timeline, the expense of it all, the financing of it. It's not necessarily cheap on the financing side either, although financing is available. And finding the equity and putting the equity together to make these kind of deals happen is not easy. And so all of these things coming together are keeping supply growth on the low end, and we expect that to continue through the near term. Some recent stats on where we're seeing averages for construction costs are here for you. You can see that the median costs are near the 200. Average is a bit higher because of the spike up when you look at how much it costs to build a full service in a luxury hotel these days. But these median costs to build are pretty high, and in many cases you can get an existing property at prices that are lower than this. And so that's also keeping kind of a check on where we're at with construction. And certainly there are some submarkets where construction is feasible at this time, but there are many others that it's just simply not yet. Construction costs, renovation costs, what's happening with those over time. This gives you an insight. This is from the Turner Cost Index. And you can see the last couple of years we're hovering right around 4%. This last first quarter came in at 1.3% just for the quarter. So if that were to continue through the rest of the year, we're looking at in the low fives, 5.2 to 5.3% growth this year, which would be a notable increase from last year. So we'll have to see how things kind of shake out through the remainder of the year. But prices keep going up. And normally we would expect to see prices going up about 4%. That's normal. Right now we're just a little bit above normal for cost increases. Want to look at luxury and independence, which include a lot of resorts, just so you can see what's happening on RevPAR right now, year to date through April. This is some pretty remarkable growth. We're looking at 7.2% in the luxury category and 4.3% in the independent category. Our category that's still struggling to get into the positive category is economy. You'll see that last year they were down 3.6, and this year they're down 1. So certainly less, and things are moving in the right direction for economy hotels, but they're not quite yet in that positive RevPAR camp. And that's mainly due to ADR. ADR hasn't been able to move in the positive direction, whereas occupancy actually is either flat or slightly up for economy hotels. Urban locations last year were the positive category for RevPAR growth when you're looking at location. This year, we're looking at some pretty substantial growth in RevPAR from resorts. And you can see that it is also very strong in the airport submarkets, and urban and suburban isn't that far behind. But resorts are really doing great. Again, looking back towards that very strong spring break season that we experienced, and maybe some of those decisions, not all, because those other occupancies stayed high, stayed pretty strong in those international destinations, but just a segment of those travelers may be choosing stateside destinations for those vacations this year. So that certainly helped boost the resort numbers. Best and worst of 2025. So these are ranked top 5 markets, change markets for RevPAR in 2025 and the worst 5 in 2025. So you can see that Las Vegas posted the biggest decline last year and San Francisco posted the biggest gain. So far this year, year to date through April, you can see that San Francisco has gotten even stronger at 23%. We're going to do a deeper dive into San Francisco in a bit with my leader there. And then you can see how these other markets are faring, all in the green. Even in the worst performing markets category, this year things are looking up. Vegas is up almost 5% year to date, even after posting those declines last year. Like I mentioned earlier, they're seeing a better convention season. And don't be too scared by the New Orleans number. They had a unfavorable comparison or an unfortunate comparison this year with not hosting the Super Bowl. And that negative number with each month that passes gets lower. And so they too might, by the end of the year, they might not eke out growth, but it certainly won't be as bad as the negative 14% implies. So all pretty strong numbers. And you can see in particular, St. Louis, San Francisco, San Diego are doing quite well this year. And before we get into our look at New York City, you can see here how our nationwide forecast shakes out. In summary, we're at 63% for this year at $164 and a RevPAR of 103. So still room to move up in the coming years. We want to get back up towards that 65% mark at some point. Wouldn't that be nice? And getting some stronger rate growth as the market allows. Okay, fantastic. I am.
Hello.
Hi, Anne. We're going to talk New York City.
We are
It
indeed.
is that one of those markets everybody always wants to know about. So I think we're looking at Manhattan in particular. So we're going to talk first about some top line numbers.
Absolutely. Good afternoon, everyone, and thanks for joining us. Before I just talk about any numbers, I just want to clarify that the numbers that you're seeing here, both historicals and forecasts, are for Manhattan, not all of New York City. So not the 4 other outer boroughs, as we call them. Manhattan has a dominant amount of supply and a dominant amount of occupied rooms and business. If we looked at the New York City as a whole, all 5 boroughs, we would see slightly softer occupancies and significantly softer average rate, but generally similar trends. So just as background. Okay. For years, I've been talking about the New York market for a while, and supply has been the number one topic and the number one concern for probably the last 2 decades. And that was originally because there was such dramatic increases in supply. Now, supply is one of the big headlines, but not because of increases, but because of the very slow growth that is now in place. And has happened for 2 or 3 reasons. The first being the citywide hotel text amendment, which basically removed the as of right permission to develop hotels in many neighborhoods throughout the city. And it was that as of right and those neighborhoods that saw the significant growth over the last 15 years anyway, that it is no longer as of right, which means there's an approval process you need to go to, which extends the time required, it extends the cost of going through that, and there is a local approval process in place that makes the likelihood of success a lot riskier. And so since that text amendment was put in place, only 4 new projects have been introduced or applied for. The ones that are there's still supply in the works, and that's all predates the text amendment. So once those sort of grandfathered in projects are through the system, the supply growth, excuse me, will slow down even more. The other thing that's happened is the city has enforced, passed legislation and enforcing it in terms of Airbnb and other short-term stays, where any unit that is in that program has to be registered and has to comply with a number of different regulations. The supply of short-term rentals has, since that passing and enforcement, has dropped by over 60%. So that alternative that a lot of potential hotel guests were considering is much less available. And those people who can't find an Airbnb or whatever are being pushed back into the hotel world. So as you can see, this is a market that has always been, or at least in the 20 years shown here, strong, performing in the mid to upper 80 range. Obviously, the pandemic and the first couple years thereafter were the exception, but it is now back to 85%. And we think because of the supply issues and continued demand growth, the occupancy will continue to inch up. It can only go up so much because there's certain times of the year, days of the week in those times of the year where there's just not demand enough to support the full array of supply. But that's what's limiting it at this point and has traditionally capped it in the mid to upper 80% range. In terms of average rate, those favorable conditions, which is limited supply, continued demand, move the revenue growth to the ADR side of things. If you're running 87% as a market, there's a significant opportunity to increase average rates. And that has been the historical dynamic, and we expect it to happen over the next couple of years. You can see, thinking back to the occupancy, in 2015 to 2019, average rate declined slightly, and that was a period when there was a significant increase in supply. Occupancy really did not fluctuate, but the hotels in the market, through their yield management strategies, et cetera, backed off average rate growth to sustain those high occupancies. And now, post-pandemic, and with the new supply constraints, the growth has been significant. So the original plan, and you'll see it worked for the other markets that we're talking about, but it didn't work for New York. We were going to talk about some key transactions and highlight those. There really haven't been any interesting ones. I mean, there have been some transactions, but nothing that it would be interesting for me to talk about or you to listen to, because the whole market has kind of been on the edge of its seat pending the new union contract. And that was announced and ratified last week. You can see here the terms, or the key terms of it. It's more complex than this, obviously. But the thing that has gotten the most press has been the increase in the hourly wage. It's supposed to increase for each of the next 8 years by $2.50, and then going up to $2.65 and $2.80, so that by the time we get to the end of, actually, by the time we get to 2030, non-tipped employees are expected to have their average increase to over $100,000, which is an increase of about 50%. There are better benefits, continued free family health care, no employee contribution, employers contributing to healthcare costs in the pension fund, an additional holiday, and benefit funds to support housing and childcare, which is to say those are very expensive elements of the cost of living in New York, and employers are now um, funding funds to support employees as they face those challenges. That's expensive. That's all expensive. There were other items on the table that did not get incorporated in the final contract that would have increased the expense. And the contract is for 8 years, which typically you would see a 4-year contract. So that 8 years at least lets owners, operators, investors know what's coming for the longer term, not the long term, but the longer term, as opposed to just 4 years. The city has also passed a number of regulations, the most significant one being the Safe Hotels Act, which limits, well, it requires every hotel to have a license, which must be renewed every 2 years. It has staffing requirements. It has limitations on the number of contract employees, which contract employees, or the limitations apply to front desk housekeeping and front service employees like bellmen and et cetera. And they also require security staff, and then no bookings of less than 4 hours except airport hotels. No comment on that, but all of this does add to the burden of management and ownership in terms of costs, in terms of logistics, and just making sure that you continue to comply. I know one of the biggest concerns that particularly some of the smaller hotel owners had when this was first proposed and then passed is, I have a hotel and I have a loan on my hotel, and to pay back my loan, I need to operate as a hotel. But what would happen if I didn't get my license renewed 2 years from now? And that's not a likelihood, but it is a significant threat if that were to happen, because if you can't operate as a hotel, no income, big problems. And then the city itself has more regulations that affect hotels, not only hotels, but buildings in the city. The facade requirements, and that's restoring the facades so that pieces of buildings don't fall down on the sidewalk, and elevator modernization requirements. Those are pretty, I don't know if I want to say reasonable, but understandable in terms of those requirements. Local Law 97, which is the greenhouse gas emissions law, requires hotels to be reduce emissions by 40% by 2030 and be carbon neutral by 2040. Or if you can't achieve that, there are fines, and some of the fines can be significant, $60, $70, $80,000. So another pressure point on profitability. And another thing that anyone investing in New York needs to have their arms around and get comfortable with before investing a significant amount of dollars, capital. Just to give you, I'll put a little sales touch in here. In terms of the union, the costs are obviously in terms of wages, but also the work rules are cumbersome. And we have done some studies where it indicates that the two identical hotels, one unionized and one not, the unionized hotel is going to be worth between 15 and 30% less. And that predates the new union contract. So if anything, we haven't obviously had a chance to research that yet. There's nothing really to work with yet, but that's not going to go down. And the degree to which it goes up will be interesting to see. There are some good news on the horizon, although the FIFA is not holding up to what was broadly expected. We think with the final game and the volume of games, that New York will see a good bump in occupancy and particularly average rate as a result of FIFA. The America 50 celebrations are expected to further support and induce domestic travel. There's continued growth across all the segments. And then last but not least, there are 3 huge casino projects that are underway or beyond underway. And collectively, those 3 represent a total investment of $11 billion. They are also in the outer boroughs, which can use stimulus like this. Obviously, Manhattan will derive some benefit, but Bronx and the Queens and the Bronx will see the greatest influx of activity as a result of these projects. So we're pretty optimistic in New York, and we're kind of waiting to see what the union impact, the new contract impact ultimately is. Thank
Good.
you.
Thanks, Anne. It sounds like maybe, hopefully, that those ADR forecasts will help lessen the blow of the expense increases. But like you said, we'll have to wait and see how that all shakes out. Yeah. All right. Thank you. We are going to move on to sunny most of the time Miami. John Lancet, our leader down in the wonderful state of Florida and the Caribbean. John's here to talk to us about how he sees this market evolving. We're going to start first with looking at occupancy, of course. John.
Thank you, Rod. I appreciate
Yeah.
it. Okay, so I mean, good news for Miami is that in the short term, our forecasted occupancy is set to enter into a stabilization period. Our forecasts are for annualized occupancy to run in the low 70s for the next 3 years. We do have a supply that is the current supply that's under construction right now for Greater Miami represents about 5.3% of our overall current inventory. It's about 3,500 rooms. We're of the opinion that this meaningful supply is going to be readily absorbed in the 8 hotel submarkets that comprise Greater Miami. I wanted to point out that the downtown submarket is kind of leading the way in terms of new inventory. We have about 2,000 rooms under construction. So for the downtown market, it represents about like an 18.2% increase. The largest markets in Greater Miami in terms of supply is Miami Beach is the lead, followed by our airport market. But with this new increase of supply for downtown, the downtown market's going to be our second largest hotel submarket soon. So if we can move on to the next slide, please. Good news on it seems like Miami is going to break a threshold soon, and the threshold is annualized average rate of $250. We're on target to break that threshold by 2028. Historically, rates have increased by slightly above inflation by 3.3% since 2004. And this year in 2026, across the different submarkets, rates are forecast to increase somewhere between 6 and 8%. But in 2027 and 2028, the rate of growth for average rate is likely going to be sub-inflationary growth as that new inventory is absorbed. Next slide, please. 3 transactions I just wanted to highlight. It's the 3 submarkets where these transactions occurred were Miami Beach, Brickell, and the airport submarket. The first one that I want to point out was the Raleigh hotel acquisition. There was 3 different properties that traded there. This transaction represented a property that was under construction. It was actually stalled, but following the acquisition, things are picking up. It really is a significant transformation of the property. Total investment there's like $1 billion that's planned. The other meaningful transaction was the East Miami transaction that was purchased by Blackstone. That was $300 million, a little bit over $800,000 a key. And then there was the Sheraton Miami Airport property that sold for about 170,000 a key. And then what I want to point out is, talking about the momentum of Miami, I'm of the opinion that we're going to continue this momentum. I'm pleased to say that I believe that Miami is going to take the third place for RevPAR of the top 25 markets of Miami. That's my prediction for 2026, and will trail behind New York and Oahu. What's really driving that is our rate growth, our rate growth for this year, for 2026. We have real solid diversification of demand in Greater Miami. A little bit over 50% comes from the domestic visitation. About 25% is international, and about 23% from our Florida residents. So I know that there's opportunity that exists for further diversification for international markets. The other thing that really influences like a base level of demand for Miami that impacts a variety of our submarkets is Port Miami. Port Miami is just a powerhouse in terms of cruise passengers and cargo traffic. And we just recently attracted a record 8.2 million cruise passengers for the fiscal year 2025. Some concerns that I have regarding the market and our competitive position going forward is competitive pressure to hotels from short-term rental inventory. It's either available or under construction in all of our 8 submarkets. It's real competition that we need to address. The other thing that I wanted to point out is we do have a supply boom in the downtown submarket. So it's going to take some time to absorb that inventory, and rates are going to be affected for downtown and Brickell. And then my opinion is that we're starting to hit a saturation point for branded residential in Miami-Dade County. So it's something I'm keeping an eye out for. So that's an update from Miami. Hand it over to John Marie for San Francisco.
Thanks, John. John to John. Let's talk San Francisco.
Hi there, everyone. Happy to be on this call with you guys this wonderful Thursday. Really happy to kind of discuss some of the positives of San Francisco and what the outlook looks like for the next couple of years. San Francisco is one of the few markets that still really remains impacted from the effects of the pandemic. We've had a very prolonged recovery with a soft convention calendar in 2024, kind of extending that recovery. But we're starting to see really, really strong momentum going in for the next couple of years, with a big rebound in performance in 25 and really, really strong year to dates through 2026. Some of these trends are really being supported by a rebound with office vacancies, return to office policies. Some of our largest employers, such as Salesforce, Gap, have now mandated 5-day return to office policies. And most of our tech companies are a minimum 3-day, still somewhat of a hybrid return to office. In 25 and 26, we have very strong convention business. And I think lastly, what's important to highlight is, you haven't seen San Francisco being portrayed in such a negative light in the media in the last couple of years. And I think that's really shifted some of the perception, not just media, but, on that transient business for both commercial and leisure travelers. San Francisco is open and welcomes all travelers. We've got a great new mayor who understands business and, more critically, understands the relationship between government and hospitality. And to that effect, there are a bunch of new initiatives such as Vacant to Vibrant, which is helping to fill retail vacancies throughout our key submarkets, that improves street conditions and really makes it more attractive for convention goers, and helping on that international side where there's a lot of San Francisco's perception being spread by word of mouth, and really cleaning up the streets and having that understanding of presenting a great city on all fronts. We're really open for business, and we're expecting strong growth for the next couple of years, at least on the demand side. Switching a little bit towards rate growth, um, you know, over the long term, San Francisco has generally kept up with inflation. For this 20-year period, it's averaged a constant annual growth rate of 3.1%. We're actually in 2026, we've seen some of the strongest growth in recent memory, supported by a really, really strong Q1 with a great JP Morgan conference in January. And then we hosted the Super Bowl again in February, exactly 10 years ago from 2016. And based on some of these strong events, strong convention business, we've got the the World Cup coming up in June and July. We're expecting rate growth to kind of fall somewhere between 8 and 12% for 2026, which is fantastic. But with strong growth comes, in 2027, it's likely to moderate somewhat. So we're expecting sub-inflationary growth in 2027, and hopefully returning back to, that longer term, 3% rate growth back in 2028. So needless to say, I guess, sorry, before we hop to the sales, on the rate side, we're getting back to peak pre-pandemic levels, by 2028. But I kind of want to mention that this is a little bit of a K-shaped recovery where, some of the stronger performing hotels, the luxury, the upper upscale are pretty much at or even past pre-pandemic levels. And what's been lagging is actually some of that limited service and more budget-oriented properties that really rely on more of that compression business, generated through strong demand at Moscone Center, to kind of drive those average rates. And so that's kind of where the missing piece is at. And I think as you start to see occupancy to continue to improve, while we're probably not ever getting back to pre-pandemic highs, as occupancy improves, that's going to drive stronger rate growth. And eventually, that K-shaped recovery will hopefully, kind of realign, and you've got strong rate growth throughout all segments of the market. With regards to some of the sales, given the slow recovery of San Francisco, there was really a dearth of sales in 2023 and virtually no sales whatsoever in 2024. As you can start to see the momentum trending, there's been a renewed interest, particularly from the private equity side, for San Francisco. San Francisco is always going to remain a highly supply constrained market, which really high barriers to entry. So what you kind of have in the city is what you've got to work with. And so there's a lot of opportunities here, just because a lot of assets, have gone through this last cycle and still require significant capital reinvestment for renovations and repositioning. And these three sales that I highlighted here are really just the most recent large sales. These all occurred kind of in Q4 of 2025 when you really started to see the momentum. But they all still somewhat represent distressed, or slightly troubled assets. So, the first one I wanted to kind of highlight is the Hilton 2-pack, which was picked up by New Bond. But this represents a very, very large distressed sale that, it represents the largest hotel in San Francisco, the Hilton Union Square, at nearly 2,000 rooms. And then its sister property, the roughly 1,000-room Park 55. This was previously owned by Park Hotels and Resorts, and they walked away from their CMBS loan in 2023 when, they faced really, really significant headwinds in 2024 with a slow convention calendar. And so, this sale at 400 million thereabouts includes an assumption of the existing debt. And this represents, somewhat of a 75% discount from when these were, last, I guess, financed, for that CMBS loan back in 2016. And I think the valuation there was close to 1.6 billion. So at 400 million, it's a pretty substantial discount to value. The other two sales, the Four Seasons was picked up by Blackstone. Westbrook had held onto this asset for quite a while, but had been experiencing some distress with some of their other assets in the market. This is one of the top performing RevPAR properties in the city, and to see it trade at under 500,000 per room, or under $1 million a room, is a pretty substantial discount for this property. And lastly, the Clancy Autograph represented a sale from Braemar, who's been trying to exit a lot of properties from their portfolio. It's a very, very interesting asset located in the Soma submarket, which is very, very supply constrained. There are very few hotels in this market. And so this property really benefits from its status, Marriott branded, it's been renovated. It's a great performing asset. But the price per key really highlights, the prolonged recovery and where investors really think, how long it's going to take to kind of get back to pre-pandemic levels. I kind of wanted to finish off with just highlighting some last tidbits, that I think will drive some additional interest into the market. First off, San Francisco has been jumping in the RevPAR metrics. So on the top 25 markets, we went from 8th to 5th. And I think this is important to note because pre-pandemic, San Francisco was neck and neck with Oahu for number 2, number 3. I know John Lancet said that Miami is looking to regain number 3, but you're only $10 above San Francisco at the end of 2025. So, I think you got to keep your eyes open. San Francisco is preparing to roar back and reclaw that number 3 position pretty soon. And to that effect, the Moscone Center, our convention center, has really, really strong business on the books, approaching 700,000 room nights. It previously peaked at close to 1 million pre-pandemic, and to see 600,000, 700,000 in 25 and 2026 with strong pace going into future years, is really going to help hotels, drive compression, see that rate growth, and see that improvement in the RevPAR standings. Office leasing, particularly for downtown, has recently hit a post-pandemic high with over 1 million square feet of new leases signed. Our word of the year, artificial intelligence, AI, as I'm sure you guys hear every day now, has really been driving a lot of that new demand. And I think we're going to continue to see office vacancies decline as we move forward. As I mentioned briefly, there's a lot of opportunities in San Francisco. Basically, everything has been on the market, on or off the market at some point. And I think if you shake the right tree, something's going to drop. So, but with that said, all the full service, kind of trophy assets that have been marketed for sale at some point in the last couple of years all require significant capital reinvestment. And when I say significant, 100,000 per room is kind of on the low end. 200, 300,000 per room is, kind of in the ballpark for some of these larger hotels. But, there's a great story, with potential repositioning, potential rebranding, even looking at potential branded residences, and conversion opportunities there. But I think the one thing to keep in mind is that, anyone who's looking for a short-term return, might need to hold off. These are long-term opportunities, probably minimum 5-year window to kind of turn these around, particularly when you're looking at such extensive need for renovation. And then to kind of temper some of these positives, just to keep in mind, while top line is kind of getting close to or back at pre-pandemic levels, you have to kind of realize that San Francisco is still one of the most expensive places to live. And we've got continued inflationary pressure on expenses and profit margins. Even if revenue is back to where we were pre-pandemic, you're not seeing the same on the bottom line, just given increased expenses. And then lastly, while AI is this, be all, save all, infinite, all-inclusive catchword that's driving strong growth for, all sorts of market segments, on residential, we've seen massive increases in apartment rents, office vacancies are declining. But, on the flip side, I'm sure you guys have seen, tremendous layoffs at LinkedIn, Meta, right? We're seeing them at Google, Apple. All the major companies are, whether or not it's truly being driven by AI, they're using this as maybe a scapegoat to kind of reduce headcount. And so over the longer term, that might cause some issues, and some headwinds. But food for thought. Hope to see you guys in San Francisco. We're open for business.
Thanks, John. Nice to see San Francisco roaring back. I want to just do a check-in with you, the audience, right now, and let you know that we have about 10 to 15 minutes of content left. Good stuff yet to share with you. So if you can just stay on with me, that would be fantastic. We'll definitely make it worth your while. If you do have to drop off the call, certainly come back to the recording and catch the last 10 or 15 minutes. You won't want to miss it. Next up, we want to do a live poll. Check back in with you to see how you're feeling. Are you agreeing with the 60% that think that the hotel industry is in a growth phase, or are you not in agreement with that? So we're going to throw up a live poll for you. If you can just take a minute to take your part in it, that would be great. Let's see where everybody's at after all that. The good, the yellow lights, the year-over-year comparisons, just what's in the news today. Everybody, one day versus the next, things do seem to change a little bit. So where are we at right now? Keep the responses coming in the poll, and we'll end the poll here in just a few seconds. Okay, great. You can go ahead and end the poll, and we'll show our responses. Okay. I think you can all see this. But we were at more on the stability side today. 50% seeing stability, 50%, 40% seeing growth, and roughly 10, 11% seeing decline. All right. Thanks for participating in that. Let's move through these final slides today, share some investment trends, see where we're seeing things out on this front. Cap rates, always good to look at those. We're looking at between 8 and 8.5 right now. Full service represents the blue line. This is from MSCI, Real Capital Analytics data, just under the 8% mark for full service and 8.5 for limited service. When we break this apart into some different property classifications, we're looking at 8.7% on limited service, 8.3 for both full and select, and then 6.5 on luxury. This is from our broker survey and kind of gives you a deeper dive on where those cap rates shake out. Certainly, we'd expect to see limited service maybe closer to the 9 or above the 9, but that popularity in the extended stay space or for the newer limited service hotel, if those come to market, that's pushing those cap rates down below the 9% mark. Select service remains also very popular, particularly if it's more newly constructed and doesn't have a major renovation coming around the corner. Those we might expect to see in the high 8s. Right now, they're drifting below 8.5. Full service, we'd probably hope to see closer to 8, but it's now drifting above that, towards the 8.5% mark, as some of those markets, as John from San Francisco was talking about, with those headwinds of major renovations to contend with, whereas luxury is the sweet spot of the moment. So those cap rates are coming in quite low in that 6 to 7% mark, and still very highly sought after in the market today. Discount rates are in that 10 to 11% mark. Certainly the luxury assets that are highly profitable, highly performing, highly sought after would see a discount rate drift much lower than that, maybe even 9 or in the 8s So there's a range of reasonableness here. Things aren't just setting on the line as shown. Similarly, on a limited service hotel that might have um, a little more concern around it for one reason or another, might see its discount rate drift up towards a 12%. But somewhere in the 10 to 11% mark is certainly the norm right now on the discount rate side. Yield rates, if we're looking at that, we are up at 18% for the limited service category, 16% on average for select serve and extended stay, and 14.5% for a full service luxury category. As I show there in the text, the range on equity yields can vary widely. A 10 point, 7 point, 8 point range on these, but this is where the averages shake out for the recent work that we've done out there with you. 65% LTV, you can see, is kind of the dominating LTV loan to value ratio for financing out there right now. The $25 to $75 million loan amount shows that orange bar there, the highest. For the smaller loans, the dark blue bar drifts up into the 70%, certainly higher LTVs available. Whereas for the larger loans above 75 million, those 60% loans end up starting to be more dominant. Debt financing is available. Just in general, certain things do have to be in place for this to happen. Some key credit drivers, not surprisingly, a strong sponsor, willingness to deepen a lender relationship, having a very credible business plan, and not being overly aggressive on your business plan and your underwriting is key in today's market. Current lending terms out there, we're seeing existing hotels with strong cash flow able to get a 65 to 75% LTV with interest rates in the low to mid sixes. 5-year term with a 25-year amortization with a personal guarantee. Proposed hotels out of the ground at 70% loan to cost at prime plus 2 to 2.5%, say the 8.5 to 9% range. Interest only during construction, and that rolls into your mini perm, that upper category once open. Sourcing equity, our sources for smaller assets, not surprisingly, largely comes from your friends and family. There is some institutional equity out there to perhaps take out partners on existing strong cash flowing assets, but harder to find the larger equity, the institutional sources for proposed hotels on the equity side. So that also ends up being friends and family, but perhaps the friends and family with deeper pockets. Some hotel transaction trends for you. We've got still not a huge increase in transactions. Buyer and sellers are not quite aligned at significant levels right now. The gap, so to speak, is still perhaps too large, and so we want that gap to minimize. Certainly, lower interest rates going forward, some more clarity in the market. All those things will lead to that gap narrowing, and we certainly hope and expect to see some stronger transaction activity in the second half of the year with all that's happening with RevPAR growth, with those hopes that are hopefully around the corner in the markets, as I discussed towards the beginning of the presentation, may lead us to some stronger transaction levels in the second half. Investor interest by property type, you can see that extended stay, that gray bar, is very high interest right now, as well as resorts. Those are strongly performing categories. Low interest on the full service side, and how the other categories kind of shake out in between. You can see how they show with interest level. Hotel prices are still relatively low versus prior peaks in the market. We'll see how this trends in the coming years if RevPAR keeps moving in the right direction, and we see the changes occur with interest rates and with market conditions. We're hopeful that we can get back up moving in the right direction. Right now, we're at about a 10% decrease from from the recent peak. And some closing thoughts for you on positioning your asset for sale. Certainly, in today's market, many of you might be waiting on the sidelines with those expectations being too different between what you might want to do as a seller or what you might want to do as a buyer. And until those narrow, there are some things you can be doing now for when you might want to sell your asset. Understand that some flexibility is needed in today's market, that there are lots of different moving parts and things that might happen during the due diligence period. So if you come into that period with some understanding of flexibility, that's going to be helpful. And it's beyond just the sale price. Flexibility is needed on all sorts of different things and all sorts of different fronts. It might, one good one, for example, might be to have a longer or accept a longer due diligence period. So all those T's can be crossed and any kind of lingering uncertainties can be worked through during that due diligence period. Something to think about. As a seller, definitely getting your arms around PIP costs and what a buyer might be facing upon purchase is important. You don't want to be surprised by a PIP budget that comes in post-contract, where then the buyer's coming back to the table and trying to retrade it with you because all of a sudden the PIP cost is $1 million more than they thought it was going to be. If you have that well in hand in advance, then that might smooth the overall transaction and the negotiating process. So something to think about going into it. And your PIP timing too. If you've had an asset where you have recently renovated and your T12 is showing some impact from that renovation, you want to be able to show the market, show your buyers that that the uptick is occurring. So even having just 6 months of better moving towards stabilization cash flow post renovation is super important, if not a year. So be thinking about when your renovation's timed. Are you going to have enough months to show that uptick in performance to really support the price that you're asking or expecting? Finally, I'll mention that which we should all be doing all of the time, but really driving revenue and looking at every single expense to try to maximize that GOP and that bottom line is super important in the months and year leading up to when you list your property for sale. You want to present the best T12 possible. And so really taking a careful look at how that's coming together and what changes you can make in order to produce that strong, market appropriate GOP is where you want to be. With that, I want to thank you for being here with us today. I want to send a shout out and big thanks to my co-presenters, Anne and John, from your respective corners of the world, of the country. I enjoyed hearing your insights. I'm sure all of you did as well. For those of you behind the scenes helping make today happen, I want to thank you too. Lisette, Jeremy, Pat, Chelsea, Janet, and Stephanie. It takes a village to put on this kind of an event. And so I really thank you for that. For those of you that asked questions during the event, I will be sure to get back to you, I promise. Give me about a week. I've got a big project to get out next week, and I'm also attending NYU and the BLLA conference, NYU being Monday and Tuesday, BLLA being Wednesday, their investment conference over on Park Avenue. Both fantastic events. If you're in New York, if you want to be in New York next week, please join me and say hi. We'll have a booth right outside the Broadway Ballroom at NYU, and I'll be speaking, moderating a panel on Tuesday afternoon. And then at the BLLA, I'll be there as well, giving a short presentation and then moderating a panel that day as well. So looking forward to New York next week. Thanks again for being here. Keep subscribing to our newsletters and follow us on LinkedIn. We're always posting some really great insights and content, and we want to help you and keep you best informed as to what's happening in our great industry. So thanks again for joining today. Have a great rest of your week and weekend. Thanks.